stock market crash of 2020. So guys, so far you've seen stocks go down thousands of points. We're down like 15 or more percent at this point. You've seen the sickness increase. You know what I'm talking about. But at the same time, did you know that the Fed is pumping $150 billion into the banking system every single day? And is your money going to be useless? All of this could be happening right now, guys. That's why I'm focusing really hard right now, and I need to put this out. I just want to say, I hope I'm wrong. I really do. I hope all of this, there's no problems. I hope in a few months everything rebounds. I hope everyone's rich in a year or two. But there's just that thing in the back of my mind saying that that's not going to happen, and I want to go over this with you. So I do want to stress, this is not necessarily the buy the dip strategy that everyone has been talking about for the past 10 years. This could be significantly different. And with everything dropping, no one really wants to look at the actual causes or what's actually going on. You might want to turn your back when you shouldn't. This meltdown could be happening right now. And I want to be straightforward with you guys, because if I have a YouTube channel and I didn't put this warning out there, even if I'm dead wrong, which I hope I am, but I have a bad feeling that I'm not, but I want to just start getting your mind thinking of what if this is it. Start thinking what you could do to actually prepare, because this might just be the beginning. So if you're retired or thinking about retiring, you might have to think again. If you're thinking of buying this dip, you might have to think again. And again, I hope I'm wrong, but what if I'm not? So everyone was saying that we are at all-time highs, that we might be in a bubble, and then all of a sudden a drop happens, and that kind of goes out the window. So let me pull back for a second and show you a big picture of things. This is the stock market. Yes, we have been in a recent drop. However, we are still, relatively speaking, at all-time highs. So if you look even back to the last one of 2008, the market got cut in half. So if we're looking at those types of situations and that level, which unfortunately I think we might be at, 2008 levels. So if you come back next year and your account is halved, which would be an issue, which is why we're talking about this. So that's why I'm saying that this might be just the beginning, because this is only a slight blip in a market crash. So yes, the sickness is growing out there. You know which one I'm talking about. I'm not going to say the name, but that's not the only problem. That's the one that everyone's focusing on, so you're not focusing on other things. So what are those other things? Well, this is an article that just came out today, and by the way, let me tell you exactly what I'm doing. So right now is Monday, March 9th, around noon. I'm in New York, so what is that, Atlantic time or whatever? So it's 12 o'clock, anything could change at this point, but that's when I'm recording this video. However, this is a report that just came out, so we're just going to start to get involved with what could be going on. So this report says pressure is growing on governments and central banks to spend hundreds of billions of dollars to stop the global economy spiraling into recession. So hold up, this isn't only about a sickness, this is something much larger, which is why before, hopefully you guys could read this by the way, so let me know on that. But that's why I said $150 billion a day. The Federal Reserve is pumping the banks. Well, some people know about it. Most people have no clue, and that's exactly what we want to focus on. So you could see this is what I'm looking at right now. The market is down. At this point, anything could happen, but it is crazy. So now let's look at other things that are collapsing, not only the markets, but some bigger picture items. And this isn't only with investors, guys. This is with savers, where your money could become useless. We're going into this later on. I don't want to make this too long. This could be a big deal, and we're going to be going into what you could be doing, what I've recently been doing. So let's continue. This is crude oil. You could see this graph has been the past year. It was around like in the 50s, you know, kind of moving up and down a little bit. And now it's just crashing. It's around, you know, low 30s and could go lower. At the same time, you could see bond yields. This, again, is a one-year chart. It was well over 2% a year ago, and right now, a 10-year bond is paying around 0.5%. Now, this should scare you a little bit, because everyone says, oh, bonds are safe. Bonds really don't move that much. Well, this is what happened recently. I think it was on Friday. Bond yields dropped, and what that means is people are piling into bonds, because when you buy more bonds, interest rates go up, the price increases. So bond yields dropped like 20% in one day. And, you know, one popular ETF, if you want to look it up, is TLT. That is like, I believe it's like a 10-year or definitely longer term treasury yield. That increased 5% in a day. Now, why are bonds moving 5% in a day? That seems pretty volatile and risky to me. And you could see that in this chart that it's plummeting. And at this point now, bonds are again, the yields anyway, are down another 20+%. So you know when your like savings account, which we're going to be talking about that in like just a minute, I'll get there. But you saw that, you know, your savings account rates have been dropping, right? Maybe last year was around 2%. Now they're dropping to maybe 1.7, moving into 1.5. The Fed dropped rates. I'm going to show you a chart in like 30 seconds. But that's what these yields are doing. You know, your savings account's getting 1%. You would think when you're investing in a longer term bond, because it's locked up for a certain amount of time, you should get more interest. But not necessarily. Right now, at 10 years, to lock up your money for 10 years, you're getting a 0.5%. 30 years, you're getting a 1%. Now, who in their right mind would buy a bond that long and lock in a rate like that? It doesn't make sense. The idea of bonds being safe might not be safe anymore. And this is the chart that kind of depicts, I don't want to say like mirrors your savings account interest rates, but it's definitely kind of related. So this, you could see a huge time span here starting from the 50s going up to the 80s, had huge increase in interest rates, and ever since then it's been a steady decline, which means as rates drop, bonds, their prices increase, which is why it was meant to be that bonds are safe assets and bonds increase over time. That's because interest rates have been declining over time. What if we reverse that direction? Well, I'm kind of getting red here. That's because I'm so passionate about this, but it's really a serious thing. And again, I could be wrong. All of this bad stuff could be wrong. It could be swept under the rug, just like it has been forever, and no one wants to focus on their problems or their debts or they're losing money, but maybe this could be an issue. And the Fed actually came out last week, I believe it was last week, for an emergency rate cut of 0.5%. The last time that, if you have no idea what this means, the fact that the Fed had to drop interest rates out of nowhere is a concern. Just because the last time they did that was also during the Great Recession of 2008. Now, this could happen again. Heck, they could be doing it right now, and I don't know because I'm recording. But, you know, so they dropped it to around like 1%. Right now, the 10-year is having 0.5%. So the Fed would probably want to drop it to at least that, so people think they're in control of the yields when they're not. I don't want to go too in detail. The big picture is that it's a problem. And these could go to zero, meaning, again, you're making no money on your savings accounts while everything else in the world increases in price due to inflation. I've been trying to subtly input some information in my previous videos. You know, like diversify your portfolio if you want. You know, hoard some cash, pay off some debt, buy some gold to preserve wealth. And no one really cares about that when markets are increasing. They're skyrocketing and no one cares about the downside. Well, what about now? You're thinking about that a lot right now, aren't you? And that's why we have to prepare, and I want to reiterate what we could be doing. All right, so hopefully you could see that. I wrote that up so you could look at that. So this is the list of what I created pretty quickly just to see how you could kind of prepare and structure what you got to be doing. Started off with number 1, Robinhood investing account. Get out of it. At this point, their reputation is gone. They have crashed multiple days where no one could trade, no one could do anything with their money. At this point, I mean, I have maybe like a few bucks with them. It's nothing crazy, so I'll just hold on to them. But if you have most of your money there, I wouldn't trust them, honestly. And there are just so many other brokerage accounts out there that you could just, there's $0 trading commissions. So like the new innovation and like specialness of Robinhood is almost gone. So you could go back to like some larger brokerages that you could actually move your money around it. So that's the first one. I did a video on that if you want to check that out. I'll leave a link in the description. Their reputation's gone. Number 2, hoard your cash. So right now, you should do cash for a couple different reasons. 1, cash is not investment, by the way. Okay? Cash is declining, especially with the Federal Reserve is just printing so much money, funneling it into the banks. So that means your dollar is decreasing. Especially if you're getting less interest in your bank, you're just losing at that point. However, when opportunities come around, maybe if the market does crash, you want cash available for whatever reason. If you want to invest more, if you need to live off of that, if you have to buy a house, especially in the short term, you need cash. So definitely save up a good amount of cash right now. And that goes for food and water as well. I don't want to fearmonger. However, what has been recently happening, I saw in the news, I don't want to like scare people, just realize this could happen. And in some places, it is happening. That people are just storming the stores, buying food and water, and just taking everything off the shelves. So, you know, I don't have like a storm shelter just filled with food and everything, but I would have a little extra food and water and cash on the side. Just in case. I'd rather be prepared than not. Just saying. I hope I'm wrong. Again, I really do. Just saying. But next would be number 4. If you have loans or debt, some people have variable rates. And that means if interest rates jump, so could yours. So if you have like student loans or a mortgage or any personal loans, if interest rates skyrocket, which it might happen because of the repo market and they spiked recently and they're trying to pump that down. Not going into detail. All I'm saying is interest rates could spike, which could destroy your life if you have variable rates. That's why you have to lock in. Rates are really low right now, so you should lock in those fixed rates. Just refi your mortgage, maybe your student loans, so you just have a fixed payment and it's not going to change. Definitely look into that. Next one, number 5, would be debt. Pay it the heck off. Don't worry about investing right now. If you have debt, you shouldn't invest. Keep it simple. You should have money set on the side, and anything extra, pay down your debt. Decrease that so much because you're just a slave at this point. You want to get out of owing people money. So decrease your debt. Any amount of debt. Credit cards, student loans, car loans. Most people lease, which I'm against, whatever. But number 6, diversification. I talked about this in recent videos. I talked about how billionaires are investing. I'll leave a link in the description if you're interested. But do not only have stocks. And you're learning exactly why right now, because, you know, stocks are fantastic when they're going up. But if they're going down, especially if this is just the beginning, and especially if they don't have any dividends, you're just losing money, getting more miserable, more depressed every single day. What if you have other assets? Look at other assets when, if stocks go down, something else could either stay the same or even increase. And that's what you need as well. You need to diversify, not only stocks and not only bonds either. We talked about bonds before. I actually don't like bonds at all right now because so many people are focusing on it. The yields are all-time lows, and I really think that's in a bubble. And if we reverse that, where bonds start becoming in a bear market versus a bull market that we've been in for the past 30, 40 years, that's going to screw people's minds up. So just look into other things. Like number 7, hard assets. Hard assets, one, I would also say like cash on hand, because this has happened multiple times in history that people ran on the banks and you couldn't get your money out. What do you do then? And it's not one of those things where like, oh, just use your debit card. No, your debit card could freeze up, your credit cards could freeze up. Then what? Start opening your mind of like, okay, you need other options. Again, even if I'm wrong, if you're prepared, I'd rather have that. So yes, have cash on hand, have a little bit extra, bury it in your backyard if you have to. Just think, what if you can't get that? You would struggle to survive, wouldn't you? And then some other hard assets, which I've been using as well, gold and silver. Not many people are talking about this. Everyone's talking about stock. You know, with Tesla shooting up, why would anyone care about anything else? Everyone's focusing on Tesla. Well, what about other things? Now that Tesla's crashing back down, gold and silver maintain its value, and you can maintain your wealth because it has a track record of thousands of years. You could see in any previous market crash or correction or depression that gold shot up. I'll show you a quick chart right here. You could see how gold moves when the market or stocks crash. Gold almost moves in the exact opposite direction. So I've been doing that as well, like physical gold, silver. You could also buy some gold and silver stocks, but at the same time, that's paper. Sometimes you just want physical assets. So that kind of goes into what you could be doing, why your money might be worthless sometimes. These are some things that you could be doing. Now, some things I've been doing. I've been hoarding cash for the past like year or two. I really haven't bought stocks. I've been continuously investing in retirement accounts. I'm fairly young. I'm 27 years old. I'm hoping that in, 20 years, this is just going to be a blip, so I'm going to keep my core positions. I did sell, maybe a week or two ago, before this market continued to drop, some like smaller positions I bought maybe like a year or so ago, and I just don't want to hold the risk anymore. I sold out of that. So now I have more cash. And what I've been doing more gold, silver. You could even diversify into gold funds. Alright, so I'm going to put some tickers in there. I'm not a financial advisor. I'm not telling you to do any of this stuff. I want you to do your own research. These are just ideas that you could look into. But if you want to buy gold, this is a ticker that you could look into. This is gold. The ticker is IAU. That's a fund that kind of mirrors the price of gold. So when stocks crash, gold would actually do very good. So that's why you could look into that. These are gold miners. So I don't want to go too deep into this. Gold miners are just mining companies, mining stocks. You're leveraging gold. So basically when gold increases, gold miners increases even faster. That also means they're more risky. But I have been, not heavily, I have got into those if you want to look into that. That's RING, so ring, or an ETF is GDX. Something to look into, not saying to buy it, just something to look at, educate yourself a little bit, and that's a way to diversify as well. So, I'm like really passionate about this. This is honestly terrifying what's going on, and I'm not seeing any reason for stocks to rebound at this point. Yeah, there might be a dead cat bounce and things could just rebound for the heck of it, but overall, I think we're on a downward spiral, and I really don't like it. I could be wrong. However, I want to put this warning out there because if something does happen, I want you guys to know what you could do, how to prepare. I know I talked a lot, but we need to talk about it. We really do. So if you guys have any questions, comments, concerns, please leave them down below. I love to hear what you guys have to say. Hopefully you could see all this. But thank you so much for watching. Be aware where your money is. That's all I gotta say. So please prepare, be careful, and let's get through this together. Thanks so much for watching. See ya in the next one.